I mean, I've seen it all going back to, I was a broker during the 87 crash. So, I watched the reflations, I watched the credit bubbles, I watched the credit bubbles blow up. And we are in a global credit bubble not ever seen in the history of man. And I would just tell you that all credit bubbles blow up throughout history. I mean, you can go back hundreds of years, and every credit bubble ever has blown up, and that's where we're headed. I do want to mention, as long as we're talking about the stock market, you just mentioned Warren Buffett. Warren Buffett, I mean, I can remember back in 1998, 99, people were saying, Warren Buffett's washed up because he wasn't buying the dot-coms. He was raising cash. He had a huge amount of cash going into 2000, 2001. And of course, the market cracked. Same thing happened again in 2007, 2008. He was raising cash, and he now, I think the number's 145 billion in cash is what he's sitting on. And that is the largest amount of cash outright, and the largest amount as a percentage that that Berkshire has ever held. So the reasoning behind him raising cash, and I mean, he says this himself, is that he can't find anything of value or of good value to purchase. So cash is a better place to sit. Now, I do believe that when this does go down, Warren Buffett is going to find out that he's sitting on the wrong type of cash, because ultimately gold and silver, they are real monies. And historically, you went to cash for safety. And if you've got a credit event happening, how safe are some of these sovereign debt securities going to be? I think we're going to find out that not everything's AAA rated, not everything's safe, and we're going to find a bunch of sovereigns that get discounted and downgraded, maybe even completely collapse.
What would I have noticed? I mean, basically, the credit bubble has continued to inflate, if you like, and we're now on the verge of seeing interest rates going into new highs. Not interest rates, sorry, bond yields. Interest rates will have to follow, I suppose. And that'll pop the bubble. So we've seen if you like, I think the best of markets, and I'm referring to equity markets, Bitcoin, all that sort of stuff, the stuff which really need credit to inflate its values. I think those days are now dying, and that, I think, was the big feature of 2024. I think the other thing I would say is that as far as the bullion banks are concerned, gold rising, 26, 27% on the year shouldn't have happened when money supply increased only 3%. So what's going on? I think around here we know basically there's a decline, if you like, in the faith of the dollar. As I keep on trying to tell people, it's not gold going up, it's the dollar going down. But I mean, I think that's the stark reality. 27% increase or 26, whatever we end up with, whereas US money supplies increased by 3%. And this is telling me, anyway, that faith in the currency is really beginning to decline now. And I think that's probably the most notable development that we've seen in 2024. I mean, we can sort of discuss details about how, for example, the stands for delivery on COMEX are just going on all the time. What does it mean? And all this sort of stuff. But the reality is that increasing numbers of central banks do realize that the risk in their reserves is in the fiat currencies. And so, in effect, they have been selling fiat currencies to buy real money, real legal money, which, the Romans first classified as legal money in 448 BC with the 12 tables. Admittedly, gold wasn't in it then. It was sort of, copper, brass type thing, and gold came later. But and if you look at Diocletian's edicts, which I think were 305 AD, so 800 years after the first Roman laws came out, and you look at the prices, the maximum prices that were permitted under the edict, and okay, we don't have slave markets anymore, so we can't compare them, but there are various things like army boots and greatcoats and togas, and beer was another one, where the prices actually today expressed in gold are really quite similar. And that's the whole point about, in money. The growth of above ground stocks has more or less kept pace with global population, averaging around about sort of 1.5%, 2% per annum. So it's not surprising that, there is a balance, if you like, in the whole thing, which means that the purchasing power of gold remains constant. All the other fiat crap, it just basically loses it and loses it and loses it. And it loses it. Normally it's an interesting one because the monetarists, they do understand the dilution, if you like, of purchasing power of a currency, which they call monetary inflation. That's one aspect of it. But the other aspect, which they haven't really grasped, is that it actually depends. The value of a currency depends on the faith in it. And it's that faith which is now being eroded. This is why I mentioned 27% increase in the price of gold, or put another way, the dollar in gold has lost a quarter of its value in the last year, whereas money supplies only increased 3%. What's that telling us? It's telling us that the dollar is actually on a very slippery slope. But the thing that's, sort of surprising in a way to some people is that the dollar is the strongest currency. You look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up because all the other rubbish is even worse. So, but measured in gold, here I am in the UK and we've got a new socialist government. Nobody here has really bought gold, but it's the one thing to have because sterling's going to go down against the dollar's going to go down against gold, interest rates, or rather bond yields, are going to rise, which is going to destroy capital markets completely. There's only one thing you can have when credit is collapsing, which is effectively what's happening, and that is gold. And I think that's really the outlook for 2025.
In that December, just on COMEX alone, there was 25,642 gold contracts delivered, the second highest delivery volume in almost 3 years. And in silver, it was ridiculously high as well. And so what we're seeing is the insiders, the big money, the central banks, the sovereign wealth funds, they're standing for delivery, as the retail investor has been, I think, mesmerized by the shiny objects over there, the Bitcoin and the Nvidia and the Apple and all of these stocks and cryptocurrencies that are posting returns. And I remember Richard Russell saying, if you make 7% a year, you're a rock star. And now gold making 30%, as you mentioned, in a year doesn't excite anybody. And that's very dangerous. But I guess at the same time, what I'm really getting at is you're right. The selling has been stronger than at any time since 2017, but so too has very large purchases by people who understand what's happening. So the person looking to make a profit, which I think is not the reason to buy gold and silver, they're looking elsewhere. The people who are looking to preserve and understand economics, understand that the math, as Bill always says, is moving into an area that is not sustainable. Well, they're contributing larger amounts of money into gold and silver, maybe even first-time clients. But the trend that I see is of the public looking elsewhere as the insiders are draining the exchanges. And that's classic misdirection, and that should portray for higher prices down the road, if I had to guess.
My experience, long-standing experience as a stockbroker, is that markets tend to move in about three waves. This is true of equity markets, but the psychology, I think, is very, very similar. And that is, after a bear market, the only people who participate early in the next bull market are basically the people who really know what they're doing, the real pros, the guys, for example, sort of in, let's say the mining industry, something like that, who understand mines. They're in there buying stuff and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community. But again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up and they buy it just because it's going up. Now we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year while the professionals have been buying is actually the clearest indication that you've got that this is in the very, very early stages of a big, big bull move.